Hello, greetings, welcome to Dividend Blasters. This is our 96th video, and our topic today is: can you unlock your portfolio's genetic code and discover your quote dividend DNA? It's kind of a neat, I think, way of saying what type of a dividend investor are you? What do you prefer to invest in? I want to cover that today. Uh, if you're new to dividend investing, you're not quite sure where to go, this video is for you. And I've been thinking about doing a video like this for a while, just to kind of give a primer of the different type of dividend investments out there, because they're all very different. A lot of them try to do different things, and you need to know what they do and why they do things before you invest in them. So I'm going to do that. So the objective is to provide an understanding of the different types of dividend investments. First, a disclaimer: I'm not your advisor. What I say is not financial advice. This video is for information and education. It reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. So do your own research, do your own due diligence before making any major financial investment decisions. So what I've done is I'm uh, providing a framework, and this is not anything new. This has been talked about by many people, experts out there. Basically, how to categorize dividend investments. So four categories here. First three relate to stocks. The last one relates to ETFs, and I have three subcategories. So first one is high dividend yield stocks. These are stocks that basically will pay a higher dividend yield, and they tend to have lower dividend growth rates. And we tend to see these stocks within the utilities sector, real estate, particularly REITs, uh, oil and gas companies, and the telecom companies. Then we have high dividend growth rate stocks. So these tend to have lower dividend yields, but because of those lower dividend yields, they can have much more robust dividend increases annually. And you tend to see these in technology. And that's, of course, when a tech stock pays a dividend. A lot of them don't. But we're starting to see that more and more where they start to pay. They have a very modest yield, usually less than 1%. They may have a double digit um, dividend growth rate. Industrials, we see this with perhaps the defense contractors, some of the office automation companies like ADP. Going back to the defense contractors, I'm thinking of like the Lockheed Martins and RTX, used to be Raytheon and Northrop Grumman, consumer discretionary, and certain financials. And when I think of the financials, I'm really thinking about the credit card companies, like the Visas and the MasterCards. Modest yield, very robust dividend growth rate. Long dividend growth streak stocks, uh, consumer staples, Coca Cola. Okay, that's one. Healthcare. You may see something like that with Johnson and Johnson. Industrials again. Okay, Northrop Grumman, uh, which is in the industrial sector, and certain financials. And I'm thinking of like the banks, the big banks like Bank of America. Uh, what else? There's others. The credit card companies too. They're actually building those growth streaks. And then of course the ETFs, and there's really three that I'm actually going to cover four of them briefly. I've listed three. The traditional dividend growth ETF, like the SCHD or the VYM, and those are the companies that invest, or the ETFs that invest in your traditional dividend payers that continually grow their dividends. Nothing fancy, very solid, very traditional. And you have something called the covered call ETFs, and this is really the thing today. These things started to become more popular 3, 4 years ago, and they are the rage today. And it's a very competitive industry. And then there's some. I also didn't mention, index fund ETFs, and there's a couple that I'll just mention. You should be aware of them, and I wouldn't even call them dividend ETFs. They're really there for exposure to the broader funds like the S&P 500 or the Nasdaq 100. And then there's a handful of new ETFs on the move and a few specialty ETFs that pay a dividend. Um, some that are focused on paying dividends, some that happen to pay a dividend. And I'll cover those. All right, let's press on. So first, you have your high dividend yield stocks. Uh, and I'm not going to read through all of these, but I'm going to just read through the first couple just to kind of give you a flavor and what's in there. And so, really, the first one you're looking at is Main Street Capital. That's a business development company that's in the financials sector. They have 6 and 2/3% yield. They got a dividend growth rate a little under 4%. It is very nice. This is my favorite, um, business development company to invest in. They've got a streak of 17 years. They pay monthly, but you know what? Every 3 months or so, they pay a special dividend as well. So you're getting a little bit more. Main Street Capital is, to me, a wonderful dividend stock in the financial sector. And I'm going to tell you, I own almost every single one of these stocks. I think I own all of them, actually. Some of them I don't have many shares of, but I like to have some exposure to them, and I just kind of build holdings. Some of them I have several shares. So anyway, next one, the telecom company Verizon, 6 and 1/3% yield, little under 2% growth rate, 20-year streak. I do like Verizon. Next one, UPS, 7 and 3/4% yield, 10 and 2/3% growth rate. Yeah, you know what? Let me say one thing about UPS and Verizon. They've really been getting beat up price wise in the market, and so like with UPS, that's why you see a really kind of a high yield and um, a nice dividend growth rate. That's something that they do, but the yield has been pushed up because the price is getting pushed down. People have been selling more of it than they've been buying. They have had some issues with unions. They've had some other management related issues. They're doing some restructuring, but it's a wonderful company and it's a great dividend payer, and I like it. I hold on to it. Next one, Pfizer, the drug company. They've also been getting beat up. I used to own many more shares of Pfizer. I have a few um, shares, 7 and 1/3 yield, 3 and 3/4% growth rate, 14-year streak. They're in the healthcare sector. I do like this next one. This is a energy company in the oil and gas storage and transportation industry. So they're kind of a midstream provider. They, work with the bigger companies that do the drilling and uh, they also work with the companies that also do the distribution. They do the storage and transportation. I mean, they work with companies that do the retail, so they're in the middle. I like that 7.5% yield. They got a modest growth rate. They got a 3-year streak going, so they're really just kind of getting their dividend career going. Horizon, I do not own this. I did own this. They have a very high yield um, and not a bad dividend growth rate, but the yield is very high. They do not have a growth streak. And with some of the monthly stocks, and of course a lot of the monthly ETFs, you really can't expect a dividend growth streak because there's lots of other factors. This dividend payout ratio is kind of high, so I don't own this, but I'm just showing this to you for instructive purposes. Next one is in the real estate sector, Realty Income, the monthly dividend company. A little under 6% yield, little under more than 3.5% growth rate. They tend to get beat up, price wise. They got a streak of 31 years, though. That's, says something. I do own shares. I used to own more of Realty Income. I actually think there are some better REITs out there right now, but I'm holding on to it, a little bit of it, a little bit more than a little bit of it, because I've had it for a while, and I think it's a good investment. Still a good investment. Duke Energy, the utility, it's an electric utility, almost 3.5% yield, about a 2% growth rate, 14-year streak. That is a utility. And the utility, 3.47% is on the low end of this list, but for utilities, that is really good. All right. High dividend growth rate. So I did mention early on about the credit card. So here you see at the top of the list Visa And then down the list a little bit, you see MasterCard. Both have yields less than 1%, but they have dividend growth rates of in the 14, 15% range. They got nice streaks, 13, 14, 15, 16 years, low payout ratio. So they can keep this thing going. When you have you have a payout ratio of like 20%, 21%, you got cash to burn and you can keep that dividend going for years. These two companies will become dividend aristocrats. McKesson, the drug company, really the same thing. Even a lower dividend payout ratio, less than 10%. AbbVie, a little bit different. They have a higher yield and a higher dividend growth rate. So 3.33%, 7% respectively. They have 11-year streak. This company, was they were the drug company for Humira, and they had patent protection, and so that was a cash machine. That thing ended, but they have a long list of drugs in the queue. But they're a little bit different. They have a much higher dividend payout ratio. They want to keep that thing going, um, and they've been kind of getting beat up the last year, price wise. AbbVie, Microsoft, modest yield, double digit growth rate, 20-year streak. So 5 years away from aristocrat status. They're in the tech sector. Um, so they're one of the cool tech companies that pay a dividend, a growing one. Broadcom, another one, the chip company. Uh, Modest yield, less than 1%, 13% growth rate, 14-year streak. Already talked about MasterCard. ADP. So they're in the industrials sector, and they basically are a payroll service provider. ADP, they got a 2% yield, 11.33% growth rate, 26-year streak. They are an aristocrat. All right. Dividend growth rate continued. Best Buy, the electronics retailer. So they got a yield a little less than 6%, 12.5% growth rate, 20-year streak, 5 years from aristocrat status. I like Best Buy, and I'm a regular customer at Best Buy. I get a lot of my computer supplies there. Waste Management, the garbage company, about a 1.5% or less yield, almost 8.33% growth rate, 21-year streak. Waste Management is in the industrial sector, so it is a good dividend payer. UPS, here we are again. They got that in excess of 10% growth rate. So we may see a few of these in multiple categories, and that's okay. They earned it. Their direct competitor, FedEx. So FedEx, a little bit different than UPS. Their yield is much less. It's about 5 points less, 2.2%. Has a much higher dividend growth rate, 16.5%. They are really getting started in their dividend paying journey, 4 years. Um, here's something interesting. Their dividend payout ratio, a little under 31%. UPS's is almost 87. So when I look at that, and I love UPS, I think that the dividend is probably safer with FedEx. But you know what? UPS is keeping it going. I'm holding on to my UPS shares. I'm holding on to my FedEx shares. Home Depot, almost 2.5% yield, little under 10% dividend growth rate, 15-year streak, and they're in the consumer discretionary sector. Home improvement retail. Costco. Costco is a consumer staples company, less than 1% yield, 13% dividend growth rate, 20-year streak, 5 years from aristocrat status. That is a very safe dividend payout ratio, less than 50%. Another utility, this is the largest utility in America, Next Era Energy, 3.22%, 10.3% dividend growth rate, 29-year dividend growth streak. They're an aristocrat. So I love my Next Era Energy. I think it's a great company to own. Johnson and Johnson, wow, healthcare company, pharmaceuticals industry, 62-year growth streak. That's the thing that really, really jumps out. here. One of the big boys, 3.11% yield, 5.4% growth rate. That dividend payout ratio is only 50%. They can keep this thing going. They can go another 62 years. Coca-Cola, little under 3% yield, 4.2% growth rate, also 62 years. Their payout ratio is a little bit higher, 68%. They're keeping it going, and they're in the consumer staples. Who would have thought that soft drink would be a consumer staple? You'd think it would be consumer discretionary, but it's a staple. Well, we all like Coca-Cola. All right, Sherwin-Williams, the paint company. This is the material sector. I don't have a lot listed here of stocks in the material sector. There's one other that I like. I didn't list it. LyondellBasell. But anyway, that's for another day. Sherwin-Williams, less than 1% yield, a little under 13% growth rate, 46-year streak. That payout ratio less than 28%. Medtronic, healthcare sector. This is a healthcare equipment company. Almost 3.25% yield, 5% growth rate, 46 years. So 4 years away from king status. 51% payout ratio. It's pretty safe. I really like Lowe's. I like Home Depot. I like Lowe's. They compete head to head with each other. It seems like every weekend I'm going to one or both of those stores. They have a streak of 61 years. So 2.12% yield, 16% growth rate, a 39% payout ratio. Very safe. They'll keep this going another 61 years easily. Walmart, less than 1% yield, so 0.95%, almost 4.5% growth rate, 51-year streak, 34% payout ratio. There are consumer staples. A lot of people look at Walmart as, hey, this is how I live. I got to buy all of my stuff to live off of it. So it is deservedly in the consumer staples sector. Lockheed Martin Industrials. This is a defense contractor. 3% yield. I do like that yield. They've been kind of flat the last couple of years, price wise, up and down, up and down. They've actually lost a little bit, but they're keeping that dividend growth rate going. So averaging 6.78%, streak 22 years. That's a safe payout ratio, 45%. Cincinnati Financial, 64 years. Wow. That's an insurance company, and they're a king. And you can be a king and not be like on the S&P 500. A little bit different than really aristocrat status, where you typically have to be S&P 500. But there's lots of different lists out there. Not terribly important. The metrics are really important. 2.33% yield, 7.7% growth rate, 64 years, 53% payout ratio. They're going to keep it going. T. Rowe Price, the asset management firm out of Baltimore, Maryland, 38 years. They've been kind of getting beat up price wise, but I like it. And to keep that streak going, that's really phenomenal. The yield is a little under 5%. And again, the price has been getting beaten down a little bit. But I like the dividend growth rate of a little under 9%. It's a very safe payout ratio of a little under 55%. They're going to keep it going. Target, the consumer staples retailer, more than 4.5% yield, 11% dividend growth rate, 56-year streak. Payout ratio, a little under 55%. That's very safe. Realty Income again, and they're in here for 31 years. That's why they're on this list. So they're an aristocrat, and they pay out monthly. And I already covered it. So let's move to Chevron, the large oil and gas company. 37 years. So they're an aristocrat, 13 years away from king status. 4.5% yield, 6% growth rate. That payout ratio is a little bit high, 78%. But I'll tell you, it's just very safe. They have so much cash. Like a lot of the oil and gas companies, it's a cash machine. So I would say I would apply a little bit of a different metric around payout ratio with some of these larger oil and gas companies. They're going to keep it going. Procter and Gamble, that is a king. Consumer staple sector, household goods, 68-year streak. So 2.81% yield, 6% growth rate, a little under 60% payout ratio. ADP, we already covered it, 29-year streak. All right. Gonna do three more in the dividend growth streak. Clorox, consumer staples, household product, cleaner. 47 years, 3 years away from king status, already an aristocrat. 4% yield, 2.85% dividend growth rate. PepsiCo, so 52 years. So they're really about 10 years behind Coke. 4% yield, 7% dividend growth rate, a little under 70% payout ratio, really about the same as Coca Cola. Um, ExxonMobil, they're about 10, 11 years behind the streak of Chevron. Chevron, I think, is the best dividend payer in the oil and gas sector. Uh, so, 26-year growth streak, 3.61% yield, 2.41% dividend growth streak, about 56% payout ratio. It's fairly safe. I actually used to own a lot of ExxonMobil, but I rolled it all into Chevron a number of years ago. I prefer Chevron, but ExxonMobil's a good one. All right, so now we're going to talk about ETFs. These are the more traditional ETFs, balanced yield and growth, and I can't start any list without starting first and foremost with the Schwab U.S. Dividend Equity ETF or SCHD. Um, I'll tell you, I when I see an ETF that pays dividends and they got a growth streak of 13 years, that gets my attention. I like that yield of 3.89%. They're not doing anything fancy. They have an algorithm where they invest only in dividend payers that meet a certain threshold. And if certain stocks don't continue to perform, they get kicked out of the ETF. And that happens when they do their annual rotation. Dividend growth rate a little under 11 years. I like that growth streak. Expense ratio. And so when we're looking at ETFs, we're looking at expense ratios. Expense ratios are basically a measure of the cost of the management of the ETF. So 0.06% is really 6 basis points of what you're investing. So if you invest $10,000 in SCHD, you're going to be paying $6 a year. I think that is a bargain. Assets under management. This is the dollar amount of the holdings that they own. 68.75 billion dollars. Another one, and this is by BlackRock or iShares, which is part of the BlackRock family. DGROW, 2.21%, 7.62% growth, 10-year growth streak. A little bit more expensive, but very reasonable, very cheap, 0.08%. It's about half the size of SCHD, 32 billion. And these are quarterly payers. These tend to be quarterly payers, are very traditional, nothing fancy. Some of the new ETFs out there are kind of fancy and slick. These are the solid ones. I prefer these in addition to some of the more steady covered call ETFs, which I'll get to. Next one is by Fidelity, and it's the Fidelity High Dividend ETF, FDVV. 3.1% yield, 7.63% growth rate. Right now, they don't have a growth streak. 0.16% ratio. This is smaller, so a little over $6 billion assets under management. And you can see, who they're tracking. They're tracking all these ETFs. They're tracking various dividend indexes. They're trying to replicate them. That's their benchmark. And I list them. I'm not going to read them all. It's not that important. Next one is by BlackRock, and it's DVY or the iShares Select Dividend ETF, 3.84% yield, 7.46% growth rate, 4-year streak. This one's a little bit more expensive, 0.38%, still very reasonable. Assets under management, a little under $20 billion. These all tend to be in that 2 to 3% yield, 6 to 7% or more growth rate. So there is a pattern here. They do tend to do sort of the same thing. SDY, which is the Spider S&P Dividend ETF, and that's by State Street Bank. 2.61% yield, 4.69% dividend growth rate. This has a streak of 2 years. 35 basis points or 0.35% expense ratio, a little under 20 billion in assets under management. VYM, this is from Vanguard. and this is the Vanguard High Dividend Yield Index Fund ETF, and 2.65% yield, 3.59% dividend growth rate, 14-year streak, 0.06%, expense ratio, 75 billion. I would say that of all of these on this list, VYM and SCHD are the most closely matched. The others are quite a bit smaller, but they're all very good, high quality dividend growth ETFs. This last one is also a very good one. Has a lower yield but a higher growth rate. This is VIG by Vanguard, the Vanguard Dividend Appreciation Index Fund ETF, 1.72% yield, 9.6% growth rate, 11-year streak, which is very good. I like that expense ratio, 0.05%, very cheap. And these bigger ones can be cheap. Okay, they can be cheaper. $108 billion in assets under management, pretty good. So this is these are the more traditional dividend growth ETFs. If you want to grow your portfolio with growing dividend holdings, you can invest in one of these and do just that. All right, let's go to the next one. So these ETFs are a little bit different. These are covered call ETFs. And basically, what's happening here is the ETF management team is investing in an index, or they're investing in holdings in an index, and you're getting a distribution. And these are all monthly. But in addition to the distribution from the dividends of the holdings, they're also selling call options. Many of them are covered calls. Some of them are just call options. Some of them are, kind of complex. And so, as a result of selling call options, they're generating premiums, and they're able to pass on some of those premiums to you, the investor. So, what are you going to see? You're going to see a higher dividend yield. And I'm not going to read all of these, but just take a look. You can see JEPI, which is the JP Morgan Equity Premium Income ETF, and JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. Uh, dividend yields a little under 9%, a little over 11.5%. Um, don't have dividend growth rates for 5 years because a lot of them haven't been around for 5 years. Some of them are just at the 5 year mark. But what you're not going to see are continuous growth streaks here, because you're not just depending on dividend payouts. You are depending also on the success of the management team generating premiums, of selling options. And ideally, they're doing that and also not having the option assigned, retaining their holdings, and doing it again. So you have a nice positive return. They can't all do that. Some are better than others. Let me just list a couple of the others. SPYI and QQQI are both by NEOS. And then the last two are by Goldman Sachs, GPIX and GPIQ. I've done a couple of videos on these, and I'll just kind of cut to the chase. 2-3 years ago, JP Morgan's JEPI and JEPQ were very revolutionary. They were new. They were the leading cover call ETFs. And there were some others out there, which I'm not even going to talk about because I think they're kind of junky. And then there's some newer ones, which they're too new for me to really, do justice to. But I would say that the game has changed, and I've actually used to own, several hundred shares of JEPI and a couple thousand shares of JEPQ. I've sold them all, and I've moved some of them into SPYI and QQQI, but the majority of them into the Goldman Sachs, GPIX, and GPIQ because they have, I think, a better option strategy. So while you can see that the yield are all about the same, and maybe JEPI and JEPQs are a little bit higher, SPY is a little bit higher. What I am looking at, and I didn't show it here, is the total return year to date. They have what I would call a dynamic option selling strategy where they will vary the amount of their holdings they're putting up for their call options, and they're also leaving plenty of opportunity for upside capital appreciation. Go back to my previous video and watch it, and I'll explain that for you a little bit more what that means. But let me just say what I like about GPIX, and this is not to make an endorsement here. I kind of did that in an earlier video. I like GPIX and GPIQs. lower expense ratio. I also like the fact that they have I think, a great options strategy. Those are my go-to ones. I no longer own JP Morgan's JEPI or JEP, really all in on GPIQ and GPIX and partially in on SPY and QQQI. All right, so those are the covered call ETFs, and they pay monthly. And just take a look at the assets under management. Um, the JP Morgan ones have been around longest, and they're much, much bigger. But I would imagine you're going to see, the Neos ones and the Goldman Sachs ones grow quickly because these are gems. All right, especially the Goldman Sachs ones. All right. So I want to just mention briefly, there's a couple of index fund ETFs here. They pay dividends. I wouldn't call them dividend ETFs, but I own these, and I think everybody should own these. This gives you wide exposure to broad market indexes and broad holdings out there. So VOO is the Vanguard S&P 500 ETF, low yield, 1.21%, a decent 5-year dividend growth rate. You don't buy this really for dividend performance. You're buying it for market exposure. You want to buy the market, own the market. Very low expense ratio. They got a growth streak of 4 years, but I'm mentioning it here. Next one, QQQ, and there's also a QQQM, which is kind of a derivation of it. It's managed by Invesco. This is the Invesco QQQ Trust ETF, 0.51% yield, very modest, but 11.6% growth rate. This is really tracking the NASDAQ 100. So you're really going to see more price appreciation here. It's very tech heavy. So you're not going to see a lot of dividends here, and you shouldn't. You want that. You want that growth, especially for you young investors. Invest in growth for growth. Expense ratio 0.2%. VO is 0.03%. Very cheap. Look at the assets under management for VOO, 1.49 trillion. It's really, I think it's the biggest ETF out there right now. It's huge. QQQ, very big for an ETF, almost $354 billion. And these are quarterly payers. And now, next one, these are low dividend specialty ETFs. And why am I showing you these? Just to give you a flavor of what else you can see out there. The first two are really what I would call semiconductor or chip ETFs. The first one is the VanEck Semiconductor ETF. The next one is the iShares Semiconductor ETF, and those are ticker symbols SMH, SOXX. So just take a look at that dividend yield. They're very modest. They're less than 1%. Dividend growth rate for SMH is 0.19%. They don't really care about paying a dividend. They got a 1-year streak. Same with SOX. Expense ratio, it's reasonable. You're buying this for exposure to the chip market, which is hot right now. It's the hottest foundational layer of artificial intelligence chips. The Nvidias and the Broadcoms and all those other great chip making companies. You can see the assets under management. SMH is by far the largest, 26 billion. SOX, managed by iShares, they're about half, 13.5 billion. So just remember that VanEck. VanEck pays an annual dividend, once a year. Don't hold your breath. Again, you want this for growth. SOX is quarterly. They're from BlackRock. The last one is interesting. I actually did a video on this, and I have shares of this. This is QTUM, and this is the Defiance Quantum ETF. Modest dividend, less than 3/4 of a percentage point. Has a growth rate of 30%, but they probably only raised it once. They got a 1-year streak. Expense ratio 0.4%, reasonable. A little under $2 billion assets under management. They invest. So whereas SMH and SOX invest in the chip companies, QTUM invests in quantum computing companies, and there's a handful of them there. IonQ, Rigetti are a couple that come to mind. They're not household names; they're very small, but they're going to become very important. All right, that's specialty. Next one, new ones on the move, and this is really the last slide of ETFs. These companies or these ETFs are managed by a company called the Vista Shares. And really, these ETFs really just kicked off a few months ago. They're very brand new. So you're not going to see a dividend growth streak. Expense ratio is a little bit higher, close to 1%, 0.95%. But they have a very unique theme. And their theme is that basically they are going to target paying a 15% yield annually. And they target 1.25% every single month. And they've been successful. They've been doing it, they've been getting it done. So the first one is QUSA, and this is known as the Vista Shares Target 15 USA Quality Income ETF. So they're investing in value stocks. I think there's about 100 of them that they invest in. You can look up the holdings, you can see, but they target paying a 15% yield. So for dividend investors that want to get a dividend and also want that wide exposure to value stocks, this to me is a good one. I own shares of this. I like this. Now they're very small, a little under $14 million assets under management, but they pay monthly. Next one is OMA. Why do you think they call it OMA? OMAH. That's the ticker symbol. So this is the Vista Shares Target 15, also a Target 15, Berkshire Select Income ETF. So they call it OMA because they are basically replicating the performance or the holdings, and ideally the performance of Berkshire Hathaway. The only difference here is that unlike Berkshire Hathaway, they pay a dividend, a monthly one. Berkshire Hathaway pays no dividends; they just collect dividends, lots of them, and then they reallocate them in their portfolio. They make oodles of money, and so it's a great stock. I like OMA. I like this ETF because they are replicating it. They're also getting it done. They're paying that monthly dividend. Um, about $420 million assets under management, a little bit bigger than QUSA. They're paying that monthly dividend. So I would check them out. But anyway, folks, that is it. Thanks for sticking with me. And I'd remind you that if you're interested as an affiliate partner of Seeking Alpha, I can offer you a discount on the best online digital subscription for investors in the world, Seeking Alpha. You can see the links below, as well as the QR codes. And click on the link or take a picture of the QR code, take you right to this the site. You'll see the discount, and I'll tell you, for premium, you will get a $30 discount and 7-day free trial. You subscribe and you decide you don't like it after 7 days, cancel it. No obligation. Alpha Picks, you get, I want to say $50. I got it on the next slide, but I'm doing it from my memory. We'll check me in just a bit. $50 off. And you're basically getting two wonderful stock picks every month from their investment team, which is top notch. And those picks kill the S&P 500. Now, I am a subscriber to both. I've been a subscriber to both for many years. Wouldn't even dream of investing without subscribing to Premium and Alpha Picks. So for folks that want to get both, you can get both of them through the bundle subscription and get, I want to say, $159 off the price. You get both, and I have both, and so I'm a more, I've been an affiliate partner for several months, almost a year, I think, but I've been a subscriber a long time for many years, and I can't say enough good things about Seeking Alpha. Here's a little bit more detail. You can read the bullets on the premium and on the alpha. And the links are there. You can also follow me on other platforms. I'm also on X, Instagram, and on Facebook. And folks, that is it. I hope you found this to be enjoyable. Thanks for sticking with me. I hope that this primer is useful. Let me know in the comments. And if you feel like I should cover something else or I missed something, let me know. I do hope that you like the video. Give us a thumbs up, share the video with a friend, and subscribe to this channel. We would love to have you. Hit that notification bell because every time we release a new video, you will be notified. Have a wonderful day. God bless.